Another powerful strategy of building long-term wealth in real estate is to invest in student rentals. Here is the goal of the strategy. The goal is to really boost the cash flow you are getting from the investment, because in this case, you're acquiring a property and you are renting it by room to students. And these properties could be close to university or close to colleges. And by doing so, you're boosting your cash flow. So you're still earning your return from the mortgage paid down and potentially from the appreciation of this property over time, but your cash flow is going to be a lot stronger because you are renting by room. The common financing mistake is that investors assume that because of the attractiveness of the cash flow, it will be easy to finance such a property. Unfortunately, the lenders don't look at student rentals the way you would as a real estate investor. They're really looking at the risk. They see a property with higher potential wear and tear and higher maintenance. Therefore, their appetite to lend on that type of property, if it's already rented by room, is going to be limited. Some lenders will say, we're not touching student rentals altogether, and some lenders will finance them, but they will cut down the loan amount from the typical 80% mortgage you would get on a regular rental to 65% or 70%, meaning you will have to put a higher down payment into the deal. Some lenders will also charge you a higher interest rate and a higher fee to compensate for the risk. The strategic solution and the pro tip here is to understand where you can finance these student rental properties, because not every lender is gonna finance them. Student rental deals are financeable by B lenders, or what we call alternative lenders, and are also financeable through some credit unions. As a real estate investor, you want to show the property to your mortgage broker as early as possible, and for the broker to gauge the lender's appetite to lend on that property early on. This way you can validate your assumptions with respect to the rate you're assuming and with respect to the down payment you're assuming, and not be surprised late in the game that you're not getting the mortgage that you anticipated, and to avoid building a financial model on faulty financial assumptions.